Every time you hear about an ETF paying 20% or 30% a year, your first thought is probably, what's the catch? Because let's be honest, high yield almost always means high risk, or slow decay. So how can some of these funds pull off massive payouts and still grow over time? In this video, I'm breaking down 5 ETFs that do exactly that. They pay huge yields without draining your portfolio. You'll see how they're built, how they turn market volatility into income, and which ones actually compound over 1, 5, and 10 years from now instead of decaying. And in the end, I'll show you an ETF that has the potential to turn a single $10,000 investment into a $150,000 portfolio and pays nearly 30 grand a year, or about $2,500 in monthly dividend income. But before we jump into the list, let's set the stage and talk about why so many high-yield ETFs don't actually build wealth and how to spot the difference. Most high-yield ETFs sound great on paper. Big monthly payouts, double-digit yields, charts that promise income freedom. But what they don't show you is what's happening underneath the surface. Your principal is slowly shrinking, aka decaying. Let's say you invest $10,000 and every month you collect those high dividends. Maybe $150 here, $200 there. It feels amazing until you check your account a year later and realize your balance has been cut in half, down to $5,000. Suddenly that 15% to 33% yield doesn't feel like income anymore. It feels like financial quicksand. That's the problem with most high-yield ETFs. They're not really earning you money. They're just handing parts of your own money back to you. It feels like income, but it's actually your future being sold off piece by piece. I've seen so many investors, good, hardworking people, fall into that trap. I've even been there myself. You think you found a gold mine, but it's really just a slow leak. So the question is, does it have to be this way? Are there high-yield ETFs that actually grow instead of decay? Turns out, yes. There are a few funds that completely change this narrative. They pay a generous income and still build long-term value. Let's count them down, starting with number 5. Global X S&P 500 Tail Risk ETF, XTR. I like to think of XTR as the workhorse. It's not built for flashy short-term returns, it's built for consistency. Designed to pay you through market turbulence, XTR is the ETF that earns income from chaos while keeping your principal intact. Here's how it works. XTR holds the same blue-chip stocks that make up the S&P 500. Companies like Nvidia, Apple, Microsoft, Amazon, Broadcom, and Tesla. In fact, its top 10 holdings make up about 40% of total assets, spread across roughly 505 positions. Technology leads the pack at 36.7%, followed by financials at 12.7%, consumer cyclicals at 10.6%, and communications at 10.3%. The rest is balanced across healthcare, industrials, and other sectors. Now, the magic of XTR isn't just in what it owns, it's how it uses those holdings. The fund overlays a tail risk strategy, which means it sells covered call options on the S&P 500 to generate income, while also buying protective put options to limit downside losses during big market drops. In simple terms, it collects premiums when the market is calm and cushions itself when volatility spikes. That's the opposite of what most high-yield ETFs do. Typical income funds chase payouts by taking more risk. XTR earns yield by reducing it. Its standard deviation of 23.25 is higher than average due to its options component, but its annualized volatility sits at a controlled 13.98%, which is below the market norm. With a turnover rate of just 3.45%, it's not constantly buying and selling, so it has a tax advantage there too. That balance of safety and income is why XTR is often called the income seatbelt. It's there to protect your capital when markets get choppy, while still paying out impressive dividends. Right now, XTR delivers an 18.38% dividend yield, paired with around 3.01% annual price appreciation. And when you let that consistency compound, the results speak for themselves. Let's say Josh invests $10,000 in XTR. The portfolio is projected to be valued at around $12,000 by the end of the first year, with about $2,000 in dividend income, roughly a 16 to 18% return in cash flow alone. By year 5, the portfolio is projected to grow to roughly $25,000, generating around $3,000 in annual dividends. By year 10, assuming those dividends are reinvested, the portfolio is projected to be valued near $57,000, producing close to $7,000 a year in dividend income. Next up is the FT-Vest Gold Strategy Quarterly Buffer ETF, ticker symbol BGLD. Think of this one as an airbag for your investment. It's built to protect when things go wrong, absorbing shocks while still delivering dependable high income. Gold has always been the investor's safety net, the asset you run to when markets wobble or inflation bites. The problem? Gold doesn't pay dividends. You buy it for security, not income. BGLD changes that completely. It turns the stability of gold into a steady cash flow machine. Here's how it works. Instead of holding physical gold, BGLD builds its returns around U.S. Treasury bills 76.21% and a First Trust Cayman Fund 23.46% that uses option strategies linked to gold's price movements. A tiny 0.33% sits in cash equivalents for liquidity. This structure keeps volatility contained while harvesting premiums from option activity, essentially transforming gold's movements into a reliable yield. It's a remarkably disciplined design. BGLD earns money whether gold drifts up or down because it collects income from option premiums, not speculative price bets. On top of that, it includes a quarterly buffer, which works like an insurance layer, absorbing small to moderate drops so your capital stays largely intact. BGLD's standard deviation of 24.46 is nearly 97% higher than the ETF average, which is normal for an options-based strategy, but its annualized volatility is only 10.55%, far below market levels, meaning it moves less than you'd expect from a high-yield fund. The turnover rate is 0%, showing there's no unnecessary trading, and its tracking error, 17.17% in year 1 and 15.16% in year 3, reflects that it intentionally deviates from the market to protect capital and sustain income. So who's this fund for? It's ideal for anyone who wants the safety of gold but doesn't want to give up steady returns. When markets fall, gold often rises, and BGLD amplifies that defensive strength while paying out consistent income. It acts as a natural stabilizer, keeping your overall returns smoother and more predictable. Right now, BGLD trades around $24.18 per share, delivering a 19.06% yield with roughly 3.99% annual price appreciation. Suppose Josh invests $10,000 in this ETF. In year 1, dividend income starts around $2,000, while the portfolio balance is roughly $12,000. By year 5, dividend income nearly doubles to about $4,000, and the portfolio balance more than doubles to approximately $27,000. Toward year 10, the growth curve steepens noticeably. Dividend income rises to about $7,000, and the portfolio balance expands impressively to nearly $62,000. It delivers about the same dividend income as number 5, but with an added boost in total value, roughly $5,000 more by the end of the 10-year period. That extra growth comes from the combination of gold stability and the fund's option income strategy, which adds value year after year without taking on extra risk. These are great returns, but there are even better options coming up. And at the end, I'll show you an ETF that has the potential to turn a single $10,000 investment into $150,000, paying nearly $30,000 a year, or about $2,500 in monthly dividend income. At number 3 is the Yield Max Semiconductor Portfolio Option Income ETF, ticker symbol CHPY. This one takes the wild energy of the semiconductor industry and turns it into a powerful high-yield income stream. CHPY profits from volatility. The semiconductor sector is known for big price swings, and this ETF turns that movement into income through a smart option-based strategy. At its core, CHPY invests entirely in semiconductor companies. 100% of its holdings are in tech. Its top 10 holdings read like the backbone of modern computing: Broadcom, NVIDIA, Lam Research, Micron, AMD, Qualcomm, Taiwan Semiconductor, and KLA Corp. Together, these make up about 75.11% of total assets spread across just 63 positions. Here's what makes CHPY stand out. Instead of relying on rising stock prices, the fund generates yield by selling covered call options on its semiconductor holdings. Each time volatility spikes, whether during earnings season or market pullbacks, CHPY collects larger premiums, which are then distributed as income. That's what's called a volatility capture strategy, and it's powerful because it produces consistent cash flow whether the market is calm or chaotic. The more movement, the higher the payout. From a risk standpoint, CHPY's annualized volatility is higher than average. That's expected for a tech-heavy fund, but its low turnover rate shows disciplined management. The tracking error sits around 1%, which tells us the fund purposely deviates from benchmarks like the Nasdaq 100 to keep yields consistent instead of simply tracking price performance. Currently, CHPY trades around $56.17 per share, offering a 20.57% dividend yield and an estimated 33.04% annual share price appreciation. But it's important to take that share price appreciation figure with caution. CHPY's structure is built around selling covered calls, which means its upside is capped. It gives up some of the growth potential in exchange for a steady high monthly income. Because of that, the real long-term appreciation will likely be much lower than the headline number suggests. For our projections, we'll use a more realistic 2% annual price appreciation. That's in line with how similar income-focused ETFs like QYLD, XYLD, and JEPI have performed over time. These funds also trade off large capital gains for consistent yield, typically growing between 0% and 3% a year while distributing substantial dividends. That 2% assumption keeps expectations grounded and reflects CHPY's true goal, delivering dependable income first and slow, steady growth second. Now let's see how those numbers could play out over time. If Josh invests $10,000 in CHPY, the investment is projected to be valued at around $12,000 by the end of the first year, generating roughly $2,000 in dividend income. By year 5, it's projected to be valued near $27,000, producing about $4,000 in annual dividends. By year 10, it's projected to reach approximately $66,000, generating close to $10,000 in annual dividend income. That makes CHPY a clear standout. Over 10 years, it delivers about $3,000 more in annual dividend income and roughly $4,000 more in total value compared to number 4. That extra growth and income come from its exposure to the fast-moving semiconductor industry, an area that keeps driving innovation and volatility, both of which CHPY turns into steady cash flow. Coming in at number 2 is the Global X Nasdaq 100 Covered Call and Growth ETF, ticker symbol QYLG. This fund has found a balance right in the middle. Half of it's built for growth, and the other half is designed for consistent income. That perfect mix is what makes it such a favorite among income-focused investors. QYLG tracks the Nasdaq 100 index, meaning it invests in the giants that define today's digital economy: NVIDIA, Apple, Microsoft, Amazon, Broadcom, Tesla, and Alphabet. These companies drive global innovation, from cloud computing to artificial intelligence, and QYLG gives you exposure to all of them in one simple ETF. The top 10 holdings make up roughly 54.65% of total assets, spread across 104 total positions. Tech dominates at 55.56%, followed by communication services at 15.68%, and consumer cyclical at 13.39%, while healthcare, industrials, and consumer defensive each add smaller but stabilizing layers of diversification. So what makes QYLG different? It's all in the structure. This ETF sells covered calls on only half of its portfolio. That means investors earn regular income from call premiums, while the other half remains untouched to capture long-term price appreciation. It's a strategy that blends the steady income of fan-favorite QYLD with the growth potential of QQQ, the best of both worlds. From a risk perspective, QYLG's standard deviation of 19.74 is about 59% higher than the ETF median, showing it accepts moderate volatility to boost returns. Its annualized volatility of 19.57% confirms that behavior, while a turnover ratio of 14.82% reflects patient, rules-based management. Its tracking error, 5.47% for year 1 and 6.14% for year 5, shows that it doesn't perfectly mirror the index, but intentionally focuses on smoother income-weighted returns. Currently, QYLG trades around $29.93 per share, offering a 23.79% dividend yield with an average 2.43% annual price appreciation. Now, let's put that into numbers. If Josh invests $10,000 in QYLG, the investment is projected to be valued at around $13,000 by the end of the first year, generating approximately $2,000 in dividend income. By year 5, it's projected to be valued near $31,000, producing about $5,000 in annual dividends. By year 10, it's projected to reach roughly $84,000, generating around $13,000 in dividend income per year. That makes QYLG the top performer so far. Both the income and growth projections surpass number 3. Over 10 years, it delivers about $3,000 more in annual dividend income and around $18,000 more in total value compared to number 3, CHPY. And finally, at number 1, I have the NEOS Bitcoin High Income ETF, ticker symbol BTCI. If you've ever wondered whether it's possible to earn massive yields from crypto without actually trading crypto, this fund is proof that you can. BTCI is built around one powerful idea: turning Bitcoin's volatility into a steady monthly cash flow. Here's how it works. BTCI doesn't directly hold Bitcoin the way a traditional crypto investor might. Instead, it combines short-term US Treasury bills, about 66.45% of its holdings, with exposure to major Bitcoin ETFs like VanEck Bitcoin ETF and iShares Bitcoin Trust ETF, alongside Bitcoin futures options. The fund sells call options on Bitcoin exposure, collecting premiums every time the asset's price moves up or down sharply. That volatility is what fuels the ETF's extraordinary yield of 32.47%. From a risk perspective, BTCI's numbers show exactly how wild Bitcoin can be. It carries a standard deviation of 38.8 and an annualized volatility of 37.58%, both more than double the ETF median. But instead of being a problem, that volatility is what the fund converts into income. Its 1% turnover rate shows a disciplined, rules-based strategy, and its 37.84% tracking error reflects that it's intentionally built to move independently of traditional markets. Currently, BTCI trades at $53.57 per share, delivering a remarkable 32.47% dividend yield and a conservative but consistent 3% annual share price appreciation. Now, let's talk about why that 3% estimate makes sense, and why it's actually a sign of strength, not weakness. Although BTCI has delivered a modest 8.35% return over the past year and a 6.06% return since inception, the fund isn't designed for explosive growth. It's built to generate consistent income through covered call strategies on Bitcoin exposure. Every time the fund sells an option, it collects a premium, but that also means its upside is capped. When Bitcoin surges, BTCI's net asset value doesn't rise as fast because it's selling those calls. On the other hand, when Bitcoin drops, those same option premiums help cushion the losses. So instead of wild swings, BTCI delivers smoother income-driven performance. It trades some of Bitcoin's massive growth potential for predictability, and that trade-off makes it one of the most reliable income plays in the crypto space. Now, let's see what this could look like over time. If Josh invests $10,000 in BTCI, the investment is projected to be valued at around $14,000 by the end of the first year, generating roughly $3,000 in dividend income. By year 5, it's projected to be valued near $43,000, producing about $9,000 in annual dividends. By year 10, it's projected to reach approximately $153,000, generating close to $30,000 in yearly dividend income, or approximately $2,500 per month in dividend income. Over 10 years, it's projected to produce about $17,000 more in annual dividend income and around $69,000 more in total value compared to number 2. And when you line it up against number 5, XTR, the most conservative fund on this list, the difference becomes even clearer. BTCI's total value projection is nearly $96,000 higher, and its annual dividend income is about $23,000 greater. Want to know how to make $8,000 a month by combining 5 powerful strategies? Click the video on screen to find out.